Hi candidates, welcome to another session of manifested online classes. So in this session, I want us to continue with the subtopic of impairment of non-cash generating assets. And in this particular session specifically, I want us to look on some illustration questions regarding how to determine the impairment loss of non-cash generating asset under the three approaches we have discussed in our previous session. That is depreciated replacement cost approach, restoration cost approach, and what we refer as the service unit approach. So let's read or go through the particular illustration. We see what we are told, and it reads, on 1st January 2009, the government built a market at a cost of 150 million. The market was expected to provide services for 40 years. On 31st of December 2018, after 10 years of use, a fire caused a severe structural damage to the market. Due to safety concern, the market was closed down for repair that would cost 106.5 million. These repairs were made to restore the market to occupiable condition. The current cost of a new market is shillings 300 million. So what are we required is to determine the impairment loss to be recognized for the market using the cost restoration approach. So what we are required to do there is we determine the impairment loss using a restoration cost approach. So the first thing which you need to remember here as a student is how do we determine the impairment loss of a non-cash generating asset under IPSAS 21. So the impairment loss is equal to the carrying amount of a non-cash generating asset, which is the same with the net book value, minus the recoverable service amount. So therefore, what we need to do for us to be able to determine this particular impairment loss, we have to determine these two values, the carrying amount and also the recoverable service amount. So let's determine we start by determining the carrying amount. Which is the same with the net book value. And we are determining this on which date? On 31st of December 2018, because what we said in our previous session is that impairment review is undertaken whenever there is a factor or indicator showing that the asset could be impaired. And actually what we are told is that on 31st of December 2018, this market, which was constructed by the government, which is a non-cash generating asset, was damaged by fire. So that is a factor which indicates that this market, which is a non-cash generating asset, could be impaired, and therefore the impairment review must be carried out on that date. So we need to have the two values on that date. So the net book value or the carrying amount, this one is equal to the cost, and we are given the cost of the market, which is 150 million. So we less the accumulated depreciation. So the accumulated depreciation in this case will be computed by taking 150 million. And then in sentence number 2, we are told that this particular market, which was constructed by the government, it was expected to provide services for the next 40 years. So anytime you're given the expected useful life of an asset, you then determine its depreciation using the straight line method. You take the cost divided by the estimated or the expected useful life of that particular asset, and then this will give us now the depreciation per annum. So what we need to do is to determine, we are determining depreciation for how many years. So from 2009, when the market was constructed or was built, up to 31st of December 2018. So how many years do we have there? So we have 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018. So these are how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 years. So meaning that our interest is to compute or to determine the accumulated depreciation for how many years? For 10 years. So this is the cost, which is 150 million. So let's compute this particular accumulated depreciation, which will be equal to 150 divided by 40 years times 10, which will give us 37.5 million. 0.5 million. We less that from the cost, and whatever you get here is the carrying amount or the net book value. So we less that from 150 million, which will give us 112.5 million. So having that, then we proceed and we determine the recoverable service amount. So we have to recall what we said in our previous session, that the recoverable service amount, this is the higher of two values, over two values. Number one, the fair value less cost to sell, which is also known as the net realizable value, net realizable, or we can just abbreviate it as, we can just put it as NRV, net realizable value, or Roman 2, what we refer as the value in what? In use, the value in use. Now, if you check on the information which are given in this particular question here, you'll be able to see that the examiner has not given us what we refer as the fair value less cost to sell, because the fair value less cost to sell, this is the amount at which now the asset can be sold at currently, minus any cost which will be incurred in selling that particular asset. And as per the information which you are given, this figure is not provided. So this figure is not provided. So therefore, this will not apply in our case. We are not going to consider that figure there. What we need to do is we proceed and we determine the value in use. Now, remember in our previous session, we said we have three methods, three approaches which can be used to determine the value in use. But in this particular question, the examiner is requiring us to do that using a method which is known as what? The restoration cost approach. So therefore, we are determining the value in use using the restoration cost approach. Restoration cost approach. So how do we determine the value in use under the restoration cost approach? So first of all, we take the replacement cost, which is basically the cost which will be incurred currently in terms of replacing that asset which is damaged. And I think in the last sentence of this particular question, we are told the current cost of a new market is 300 million. So if the government want to construct a similar market currently, that will cost the government 300 million, meaning that this is the replacement cost. Then what we do, we depreciate this replacement cost for this equivalent duration. So what that means is that to this replacement cost, we less accumulated depreciation, which will be equal to the replacement cost. And then we are saying we depreciate 300 million for an equivalent duration. So meaning we divide that with 40, just like what you have done here, times what? Times 10. So this will give us now an amount of how much? So we have 300 million divided by 40 times 10. So which will give us 75 million. We less it from that figure, which will give us 225 million. So whatever you have here, we refer to this as depreciated replacement cost. Now, after getting that under this particular approach here, we proceed and we less the restoration cost. So remember, we said the restoration cost in our previous session is the cost which will be incurred in terms of restoring an asset to its pre-impaired state. So essentially we said that this is equivalent to the repair cost. How much repair costs will be incurred by this particular public sector entity in terms of repairing an asset which is now deemed to be impaired? And I think if we go back to the question which you are given, to the information which you are given, we are told due to the safety concern, this market was closed down for a repair to be done, and we are told that repair will cost, or basically the repair cost is 106.5 million. So that is now the restoration cost. So we raise it from our figure up there. So we have 225 minus 106.5. So which will give us 118.5 million. 0.5 million. Yes. So this is now what? This is the value in use. The value in use. So having the value in use, next what we need to do is to determine now the recoverable service amount. The recoverable service amount, of which you are saying the recoverable service amount should be the higher of these two values. Should be the higher of what? Of the fair value less cost to sell, this one, and the value in use. And take into account we don't have this value, it is obvious that our recoverable service amount will be equal to the value in use. So therefore the recoverable service amount is 118.5 million. 0.5 million. So having that value, what we need to do is to determine whether this asset is impaired or not. Remember we said that an asset is said to be impaired whereby the recoverable service amount of such an asset is less than the carrying amount. So in our case, we already have these two values. So we have the recoverable service amount, which is a figure of 118.5 million. What about the carrying amount? The carrying amount is what we have here. That is 112.5 million. So we need to check, is this particular amount here, recoverable service amount, is it less than this? So obvious, this one is not less. This one is not less than the carrying amount, is not less than the carrying amount. What does that mean? It means that this particular market here, this particular non-cash generating asset here is not impaired. Is not what? Impaired. Therefore, no impairment loss which is to be recognized. So that will be the answer here. So we say the asset is not impaired, simply because the recoverable service amount is not less than what? The carrying amount. The asset is not impaired, and therefore no impairment loss is to be recognized. No impairment loss is to be what? Is to be recognized. So basically that is it, that what was required. So let's move to the other illustration, and it reads, on 1st of January 2014, the government acquired a modern software to enhance the service delivery at a cost of 350 billion. The software had estimated useful life for over 8 years, and its benefits would accrue evenly on a straight line basis over the software useful life. As at 31st of December 2018, the usage of the software had dropped to 15% of its originally anticipated demand. A software to replace the remaining service potential of the existing software would cost 150 million. So what are we required? We are required to determine the impairment loss to be recognized for the software using the depreciated replacement cost approach. So here what we are required, remember this was Roman 1 of our illustration. That was Roman 1. Roman 2, we are also required to determine the impairment loss to be recognized, but using which approach? Using the depreciated replacement cost approach. And it is also important for you to recall that the difference between these three methods, what we have done here, restoration cost approach, the depreciated replacement cost approach and the service unit approach, the difference is purely how we determine the value in use. So how we determine the carrying amount and the net realizable value, the approach is the same. The difference comes in when determining the value in what? In use. So what we just need to remember here is, or we need to have the formula for computing the impairment loss, which you have said is equal to carrying amount, which is the same with the net book value of the asset, minus the recoverable service amount. So we need to determine these two values, and basically we are determining this particular impairment loss on the date when there was some evidence showing that this particular asset could be impaired. And I think there is some information which you are told there, or which you are given, whereby you are told on 31st of December 2018, the usage of this software had dropped by 15%. Had dropped by 15 what? Percent. So meaning that the performance of this particular software is worse than what was originally expected. So this is one of the factors which indicate that this particular asset could be impaired, and therefore in accordance with IPSAS 21, the public sector entity should carry out impairment review at the end of 2018. So therefore we are determining this carrying amount, this particular net book value, on that date, on 31st of December 2018. So to compute this is basically quite simple. We take the costs of the software, which we are given in the first paragraph, which is 350 million, and then we less the accumulated depreciation. How do we compute the accumulated depreciation? We take 350 million, divide that with the expected useful life of this asset, which are 8 years, and then on this date, this particular software had been used for how many years? So remember, it was acquired at the start of 2014. So meaning that it was used, the software was used in 2014, 2015, 2016, 2017, 2018. Those are how many years? 1, 2, 3, 4, 5. So we need to compute the accumulated depreciation for 5 years. And basically that will give us what? That will give us the net book value or the carrying amount. So let's compute that. We work out that. We have 350 divided by 8 times 5. We rest that from the cost of 350, and that will give us 131.25 million. So that is the carrying amount or the net book value at the end of 2018. So then from there we proceed, and we already have this, we proceed, we determine the recoverable service amount. Recoverable service amount. That is the abbreviation for that, recoverable service amount. And basically this is the higher of two values. This is the higher of two values. Number one, the net realizable value or fair value less cost to sell. And equally, if you check on the information given in this particular question here, this figure is not given. We are not given the NRV, the net realizable value or the fair value less cost to sell. So that will not apply here. So we take the higher of that, or number two, what we refer as the value in use. The value in what? In use. Now the value in use, which approach are we using here? The examiner requires to compute this using this particular approach, the depreciated replacement cost approach. So therefore, that is the approach which you're using here, depreciated replacement cost what? Approach. Yes, so let's determine the value in use under that particular approach or method. Value in use. So to determine the value in use, what we do, we take the replacement cost. The replacement cost is basically the cost which will be incurred by the government in constructing a similar market. We are given that information, not a similar market, but in terms of acquiring a similar software. A similar software, we are told acquiring a similar software currently, or a similar software currently goes for 150 million, and we depreciate this, or to this we less accumulated depreciation. which will be equal to the replacement cost, which is 150, and we depreciate this for an equivalent duration as this particular asset. Divide that with 8 times what? Times 5. Times 5. So let's work out that. We see what it will give us. We see what we are going to get here. We have 150 divided by 8 times what? Times 5. Times 5, which will give us 93.75 million. And whatever you get here is now the value in what? In use. So that is how we determine the value in use under this particular approach here, or under this method, which is depreciated replacement costs approach, which is 56.25. So having that, finally, we need to get now the recoverable service amount. Recoverable service amount. The recoverable service amount, you should take now the higher of this value in the value in use and the fair value less cost to sell. In our case, remember, we don't have that, so automatically our value in use will be equal. Sorry, our recoverable service amount will be equal to the value in use, 56.25 million. 0.25 what? Million. So having that, then we equally need to determine whether our asset is impaired or not by checking whether the recoverable service amount, whether this amount is less than the carrying amount. Is less than the carrying amount. This was supposed to be less. It's supposed to be less than the carrying amount. So the recoverable service amount is 56.25 M. What about the carrying amount? Is this one, 131.25 million. So in our case, we can say this one, the recoverable service amount is what? Is less than this one. So meaning that we need to proceed and we determine what? The impairment loss. So the impairment loss is determined using this formula. So the impairment loss is equal to carrying amount, which you already have here, 131.25 million minus the recoverable service amount, which we have here, 56.25 million. And we get the difference. We get the difference. Yes, so which will be 75 million. 75 million. So that is basically the impairment loss, or how we determine the impairment loss using that particular what? Using that particular approach, which is known as the depreciated replacement what? Cost. I want us to look on the last illustration. We look on the last illustration. So let's go through the illustration. We see what we are told. So the illustration leads with reference to IPSAS 26, which deals with the impairment of cash generating asset, explaining the following terms. So IPSAS 26 basically is equivalent to IAS 36. So the definition of those particular terms under IAS 36 is the same with the IPSAS 26. So the first term we are required to define is the value in use. So the value in use, in very simple terms, is the present value of the expected cash flows to be generated from the continued use of the asset and also from its what? Disposal. So what about the recoverable amount? The recoverable amount, this one, is the higher. We say this is the higher of cash generating assets, value in use, or number 2, fair value less cost to sell. Less cost to sell. That is how we define those particular terms. And then part B, that is what I want us we compute here, or basically we do. So we are told on 1st January 2008, Mashabani County Education Department purchased a printing machine at a cost of 40 million. The department estimated that the useful life of the machine would be 10 years. And then you are told on 31st of December 2012, it was reported that automated feature of the machine function did not operate as expected, resulting in 25% reduction in the machine annual output over the remaining 5 years of its useful life. The cost of a new printing machine was 45 million as at 31st of December 2012. So what are we required to do? We're required to determine the impairment loss using the service unit approach. So we are required to determine the impairment loss using service unit approach. Using a service unit what approach. The first thing always you need to have here is the formula for computing the impairment loss. The impairment loss is equal to a carrying amount of the asset minus the recoverable service amount. Recoverable service amount. So we need to have these two values. Let's start by determining this one, carrying amount. Carrying amount, which is basically the same with the net book what value. And equally we are determining this when there was a factor which showed that this asset could be impaired. And there is some information which are given in that question that on 31st of December 2012, it was reported that automated feature of this machine was not operating as expected, resulting in 25% reduction in the machine annual output. It means that the performance of this asset was worse than what was originally expected due to that feature, automated feature of the machine not working as what as expected. Therefore, an impairment review was supposed to be conducted on 31st of December 2012. So how do we determine the carrying amount? We take the cost, which we are given in paragraph 1 as 40 million. 40 million, we less the accumulated depreciation. The accumulated depreciation would be 40 million. Divide this with the expected useful life of this machine, which are 10 years, and then times the number of years the machine had been used before the end of, or basically as at 31st of December 2012. So how many years do we have? Take into account it was acquired in 2008. So we have 2008, 2009, and then we also have 2010, 2011, 2012. So these are 5 years. 1, 2, 3, 4, 5. So we have 5 years. 5 years. So this will give us what? This will give us 20, meaning that the carrying amount or the net book value will be what? Will be 20 million. So having that, we proceed and we determine now the recoverable service amount. The recoverable service amount, which we know by now that this is the higher of two values. Higher of number 1, net realizable value, or the fair value less cost to sell. And in our case, equally, we are not given this. We are not given this. In most of the questions, it is important to note that you not be given that fair value less cost to sell, because it is very rare for the government to be able to sell its asset. To be able to sell its what? Its asset. That's why you can see actually in all questions which you have done, there is nowhere you have been given, or there is no question or no illustration whereby you are given the fair value less cost to sell. So we take the higher of that all. Number 2, the value in use. The value in what? In use. Now, this value in use, we are required to compute that using this approach here. The service unit what? Approach. Service unit what? Approach. So how do we determine the value in using this particular approach? The first thing we need to do is to compute the depreciated replacement cost. So we take now the replacement cost, which is also given in that question in the last sentence, whereby you are given the cost of a new printing machine. If the government wants to acquire a new printing machine currently, such a machine will be bought at 45 million. So what we need to do is we less accumulated depreciation, which is computed by taking the replacement cost, and then we depreciate that amount with an equivalent duration. So we divide this with 10 times what? Times 5, which is basically half of that, 22.5 million. And whatever you get here is known as the depreciated replacement cost, which equal to be 22.5 5 million. So having this depreciated replacement cost and the service unit approach, we say to get the value in use, we take the depreciated replacement cost and then we multiply that with the proportion of the remaining service potential. We multiply that with the proportion of the remaining service potential. There is something which you are given in that particular question whereby we are told, due to that automated feature of the machine not operating as expected, the annual output of this machine in the next 5 years was expected to reduce by 25%. So meaning that the remaining service potential of this particular machine over the next 5 years, we can say is 75%, because the annual output of this machine in the next 5 years is expected now to do what? To reduce by 25%. So therefore, what we have done to compute the value in use, we have taken the depreciated replacement cost and then we have adjusted that, we have multiplied that with the proportion of the remaining service remaining service units. So we have 22.5 times 75%, which will give us now what? Which will give us 16.875 million. And I think now having that, finally what we need to do is to determine the recoverable service amount. We determine the recoverable service amount, of which the recoverable service amount automatically will be the higher of these two values here. So remember, in our case, we don't have this. So automatically the recoverable service amount will be equal to value in use. The value in use is this one, which is 22.5 million. 0.5 what? A million. And I think having that, finally, we need to determine whether this asset is impaired or not by comparing the two values, by determining whether the recoverable service amount is less than carrying amount. So our carrying amount, we have it here, 20 million. What about the recoverable service amount? Is 22 point, not 22, sorry. This should be whatever I have determined here. Let's change that. So this, the recoverable service amount is 16.875 million. So our recoverable service amount is 16.875 million. So what we need to do is basically to determine, is this less than that? Yes. So we can see the recoverable service amount is less than the carrying what amount. If that is the case, then finally we need to determine the impairment loss, because this particular asset is impaired. The recoverable service amount is less than the carrying amount. So the impairment loss will be equal to carrying amount, which is 20 million, minus the recoverable service amount, which is 16.875 million. So what will be the difference here? It is 3.125 million. And that is the impairment what? The impairment loss. So basically that is it, that what was required in those particular three illustrations, whereby the examiner was requiring as a candidate, you compute the impairment loss of non-cash generating asset in accordance with the IPSAS 2021. So therefore, we have looked on how to compute the impairment loss under the depreciated replacement cost approach, under the restoration cost approach, and also under the service unit approach. And basically that brings us now to the end of that subtopic. So once we meet in our next session, we are going to look on how we determine the impairment loss under IPSAS 26. So for now, we stop at that point. See you in the next session.